Here you go.
Thanks, honey.
Move it! Move it! Hi, I'm Debbie Bennett.
And I'm David Bennett with Financiers Mortgage Group.
And welcome to our video update for the week of February 16th, 2012.
I may be out of breath, but I'm feeling some better. I still can't drive, but I'm working on a comeback. As part of my workout routine, I just finished my 10-mile run. Of course, I started last Friday. Now remember last time I told you whether you're a buyer, a builder, or a realtor, you have to change your game plan in the next couple of months. Coming soon to an FHA loan near you are going to be many changes. Well, I've been caught by surprise by how rapidly some of these changes are beginning to appear. I'm already getting notices that the FHA secondary market is going to be upping the minimum FICO score requirements from 620 back to 640. I told you last time that FHA had near record delinquencies, which is causing FHA to tighten their guidelines themselves, but also they were reducing lender autonomy. So now the lender's only able to make loans in this sweet spot. They've either got to hit the sweet spot, turn them down, or send them to FHA for approval, which most of them aren't going to do. Right now I can still get FHA loans done down to a 560 credit score, but I suspect that in the near future either that 560 is going to rise or else the cost to do that is going to rise. But like we learned last week, when one door closes, another door opens. Well, I sound like Hedda Hopper, but you heard it here first. Last week I was talking about the FHA MIP and all the reasons why we thought the rate would be going up. Now this week there's been article after article talking about the impending FHA MIP rate increase. They've already implemented a 0.25% increase on the FHA jumbo loans. That's the loans in the high cost areas, which we're not near, so we don't have to worry about that. But the articles make it appear the rate increase might be happening faster than I thought. Now one of the main reasons the FHA MIP rate will be rising is the election. Don't act surprised you knew politics would come into play somehow this year. I mean, it's an election year. They've determined that a reasonable 0.1% increase on normal loans and the 0.25% on the jumbo loans isn't going to be enough to get FHA back in the black till 2015, which means FHA is going to need a bailout. They estimate the bailout to be $688 to $750 million. Here's the politics part. Obama doesn't want a bailout to show on his physical budget report that he's got to present to Congress in the next couple of months. Therefore, we need a significant FHA MIP rate increase. There's a whole lot more information on this on my daily update page you can find right over there. Now one thing I want to clarify from last week before I go on. After I filmed, but before I got the editing done, I found out that I had at least one MI company that would do a 95% conventional loan down to a 620 score. Technically, 97% loans are still available, but right now FHA MIP is cheaper than 97% PMI. But once the FHA rates rise, then maybe the 97% conventional loans will make more sense. Even if they're the same price though, the conventional would still be cheaper because you can get rid of the conventional PMI much faster and much easier than you get rid of FHA MIP. Now I've also found out that those 580 credit score conventional loan programs that we used to have, they're still in the books. I thought they'd been wiped off, but no they haven't. The lenders are just scared to use them. And you can't blame them. They got blamed for the congressionally mandated 100% loan to value no doc loans. So what's that old saying about once burned, twice shy? But in any case, it means they exist, so one day they may come back. I'm just hoping sooner rather than later. And speaking of 580 credit scores, I can do 580 credit scores on FHA loans right now. I can do them at the standard 3.5% down payment. Most lenders require a 5% down payment to do a 580 score. I could even do a 560 FHA loan, but that does require the larger down payment. Well, I've had to put it off for a couple weeks because we simply hadn't had time, but this week finally we can talk about how you get rid of your mortgage insurance. And that depends upon the loan type. Each one has a completely different way to do it. Now, VA just is. USDA is forever also. But conventional loans can be removed when either your loan drops to 80% of the original value, or when you can prove that present loan balance is 80% or less of present value. Now, that's going to require an appraisal because you'd hope the tax appraisal is way low. Now, actually, I misspoke there. They're not tax appraisals. They're tax assessments. A lot of people worry that this appraisal will go to the taxing authorities and they'll know what you paid for the house and your taxes will go up. And that's simply not true. They're not even allowed to see this appraisal. Texas is a non-disclosure state. So unless you give it to them, they don't have access to it, nor do they have access to the MLS records of what your home sold for. Now, with FHA, regardless of the original loan to value, you must keep your MIP for 5 years, and you can't get rid of it until it drops below 78%, and you're not allowed to get an appraisal to prove your value's gone up. Now, before I forget it, if you want to see any past week's videos, you can go up to the nav bar up top here, and it's labeled Movie 1, Movie 2, Movie 3. I encourage you to send these links to your friends, neighbors, colleagues. If you're wanting to look through there, I put a summary of each video, so you don't have to look through all of them to find everything in there. You can just read the summary and find out this is the video I want to see. I'd also like to answer a couple of questions or clear up a couple of fallacies that arose this week. First of all, USDA is not just for rural property. It is for lower population density areas, but many of the cities around, the whole city's eligible. It also has an income limitation, but that depends on how many are on the family. Now, I've also got the choice loan that goes a little further than USDA, and all of these are 100% loan to values, no down payment. I've done up to 440, I believe it is, with 0 down. Also, credit scores. There are many different credit scores. Now, first of all, you have 3 bureaus. Each bureau has their own score for you because they each have different information and they have a different scoring system. But also, each bureau releases a score that is weighted based upon the purpose of the pull. So, if you were to pull one for yourself, that's the generic version, and we would hope it's close to the middle of the score, but there could be 30 or 40 points spread on either side depending on the loan pull. If you're pulling it for a credit card, they will weight it so it looks at how you pay your credit cards. If you're doing it for a car loan, they'll weight it to show how you paid past car loans. For credit cards, there are a couple different scores for them even because there are a couple different types. If you're going for a mortgage loan, well, they'll look at how you paid your mortgages. You might have an 800 credit score for a mortgage, but for credit cards, you might have a 620 because you might have had some lates on old credit cards way back when, which really aren't affecting us for your mortgage, but are affecting for credit card pulls. So the only way, let me stress this, the only way that you can know what someone's credit score is to work with is for us to pull it and see what the mortgage score is. That's the only one that matters. Hopefully that'll help clear things up for you. Now here's a tidbit. In today's climate, it's easy to forget that VA has some closing costs the veteran isn't allowed to pay. Almost every contract we see has the seller paying all or almost all of the buyer's closing costs. Well, that exceeds the VA requirements. But if you're going to write a contract where the seller isn't paying all their closing costs, you have to be aware there's about $1,500 to $1,700 in costs the veteran can't pay. That'll have to go to the seller's side. Well, or maybe come out of your commission if you're the one that made the mistake. Here's a big VA plus. VA appraisals have changed less than any of them. So they're the one that's most likely to give you an appraisal for value, which means you're less likely to lose a contract because the appraisal come in too low.
Well, that's it for this week. I hope we've been helpful. You can call us anytime, day or night, with your loan questions or your loan scenarios. So until next week,